Hello everyone, thank you for joining us on this webinar that we have titled The Key Questions to Ask Your Fixed Income Manager. My name is Vinnie Wadhera. I'm an Executive Director here at BetaShares, responsible for our advisor and institutional business. I'm also joined here, and I'm also joined here by my colleague Chamath De Silva.
Hello everyone, thanks for joining.
Chamath is our Senior Portfolio Manager. He's been with BetaShares for over 4 years now. He has been responsible for formulating and designing the BetaShares fixed income ETF suite. He's also on an ongoing basis responsible for the implementation and management of this ETF suite. Prior to BetaShares, he was with the RBA for 7 years as a senior analyst in their international financial markets division, working in their Sydney and London offices. Before we start, I might just highlight that the information we're presenting here is for financial advisors only and not to be distributed to retail clients, and is general information in nature only. I'll also just highlight that a copy of the presentation will be available after this afternoon, and importantly also a copy of the slides and also a question worksheet that will be running through today. That'll also be included as part of the follow-up. So let's move to the agenda. As we'd mentioned, I'm going to provide just a very quick overview of BetaShares. We are going to touch on these topics. This is not meant to be a fixed income 101 and definitions webinar. We want to get into some actual details and really addressing a lot of the points that we've had discussions with many of you, particularly over the last few months. And then we'll also share our building block and efficient solutions towards the end. In terms of BetaShares, we now have 62 ETFs on the ASX. That makes us the largest number of, in terms of a provider of ETFs. These span across traditional passive exposures, smart beta, factor strategies, and including the partnerships that we have with active managers for active ETFs. Our fund size has actually just recently ticked over $12 billion, and our market share, you can see here compared to other ETF managers, we rank number 2. It's a very close difference there between number 1 and 2 in terms of net inflows year to date to 2020, and there's a big difference there between number 2 and number 3. Look, we really do put this down to our product suite and being able to demonstrate the unique features and the applicability to portfolios. Also our client service, but also your efforts, all of your efforts as institutional investors and advisors to review and select our ETFs in your client portfolio. So thank you very much for all of your support. Let's now move to the actual topics on fixed income that we're going to cover. I should just highlight, so fixed income is an established asset class in asset allocation frameworks. It's in there because it does have defined return and risk outcomes that are able to be modeled and added into optimizers. The important point is that the fixed income asset class is not homogeneous. There are sub-components of the fixed income market that produce very different results and outcomes in different market environments. What we've listed here really is the main objectives or outcomes that you are seeking from fixed income. And they can be either diversification against other asset classes. So this fixed income asset class will hold its value or go up in certain market environments or scenarios. Number 2, it will provide regular and reliable income. And the third objective, it will have capital stability and preserve capital. Now it's interesting that there is no magic pudding here, as unlike the adventures of Bunyip Bluegum and Billy Barnside. There is no fund or fund manager that can actually maximize all 3 of these objectives. And if anyone does claim they can do that, then I think you need to give them a copy of Norman Lindsay's book. But importantly, as a practitioner of portfolio construction, the role is to diagnose and understand which of these objectives is important to you, your portfolio, and your clients, and in what proportion to utilize underlying strategies that meet these objectives. So let's come back to these objectives at the end. It's very important. Let's now move to the strategy selection. What we've observed in this space is that, particularly with institutional investors, asset allocation frameworks from research houses, model portfolio groups, is that traditional bond indices, like composites, like aggregates, are used as benchmarks and really measurement outcomes of a portfolio. And they are increasingly not being used as actual exposures of the portfolio. So Chamath, let me hand over to you now, please. So what are the identifiable problems with traditional bond indices?
Yeah, thanks, Vinny. So, I mean, at a high level, fixed income should not be one size fits all, but it should be a tailored solution to fit your individual portfolio's needs. Unfortunately, the traditional benchmarks, because they are liability weighted, issuers and issuer behavior set the risk profile. And that might not be what your portfolio needs, and that might not meet your investment objectives. The other thing about liability weighted indices is that they have unstable risk profiles over time. The most notable one being duration creep. That's where the level of interest rate risk in a benchmark or in an index can fluctuate wildly over time with issuance patterns. For example, let's take the two major benchmarks, the Bloomberg Oz Bond Composite and the Bloomberg Barclays Global Aggregate. They have had, a fairly unstable duration profile, especially over the last 10 years. So with the Oz Bond Composite, back in 2009, its effective duration was slightly over 3 years, whereas today it's just shy of 6 years. So that's a big change in the level of interest rate risk in this index. But importantly, we don't know what the level of interest rate risk will be in 5 years' time or 10 years' time or over your strategic asset allocation horizon. The other issue is segment creep, and segment creep is the split between, say, government and corporate. And that can also have a big bearing on the risk profile, not only of the index, but of how that index interacts with what else you're holding in your portfolio.
Thank you, Chamath. That's a great demonstration there of some of the issues and problems of traditional bond indices. Let's now move to then if that's an issue there with using traditional bond indices as your portfolio exposure, let's now move to what the issues are with active managers and generally what the results have been, Chamath, and why that is the case.
Yeah, so just starting with S&P's SPIVA report, the results haven't been great for active managers, particularly in fixed income. So over the past 10 years, 85% of fixed income active managers have underperformed their benchmark, and over the past 5 years, 81% have underperformed. But probably the worst thing about this fact is that the underperformance has been most acute during periods of market stress and periods of equity drawdowns. So not only have active managers in aggregate underperformed over an extended period of time, they've underperformed to the greatest extent when fixed income is most needed as a portfolio ballast. So in general, fixed income active managers have underperformed the broad index and delivered lower equity diversification, particularly during price episodes. Now, this is largely due to structural overweight positions to credit and often underweight positions to rate duration, which both undermine equity diversification. Now, the issue is at, say, a median management fee of 60 basis points, it seems investors have been paying for this privilege, quote unquote, of having more equity beta in what should be a defensive building block. But why has this happened? And really it comes down to incentives. Now, active managers tend to focus on their benchmark rather than delivering the needs for their clients' portfolios, because they don't know how much equities you're holding. They don't know what type of equities you're holding. So they don't know what's the best split between credit and duration that your portfolio needs. But when viewed in isolation, if you're just trying to beat a benchmark either in absolute or risk-adjusted returns, then a long credit short duration bet, tends to be a way of achieving higher risk-adjusted returns in isolation, but worse overall portfolio outcomes, particularly during crisis periods. And I alluded to this before, but with the median management fee at 60 basis points and in a low yielding world, active managers are further incentivized to be structurally overweight to credit and search for yield in order to, justify the fees that they're charging. And finally, alpha generation, it's hard, especially in investment grade, because they are competing with other sophisticated investors that operate in debt markets, and the fees alone are a big hurdle to overcome. But this is not just an Australian phenomenon, this is global. So AQR have done extensive research on sources of alpha within fixed income, and looking at active fixed income managers across US mutual funds, they found that active returns are highly correlated with credit. So basically, there is a bit of a myth of active alpha in fixed income, in that they're taking structural credit bets, both the managers benchmarked against a US aggregate and those benchmarked against a global aggregate. And visually, this is what a long credit bet looks like versus a long duration bet. So the green line visually shows a long duration bet. So that is just the relative return of very long dated treasuries versus 10-year treasuries, whereas a white line is an example of a long credit bet, which is a position in 10-year investment grade corporate bonds versus 10-year treasuries. And what do we see? We see very large drawdowns in that active credit bet during crisis episodes and periods of significant equity drawdowns. And what's interesting about this relationship is that correlation between long duration and long credit has actually become more negative in recent years, which suggests that in a low inflation, low yielding environment, active managers are collectively chasing yield through credit, and unfortunately are collectively capitulating when things get difficult.
No, thanks, Chamath. I think that's very, very interesting, because intuitively you'd think that if you're demonstrating that, well, those composite benchmarks have their flaws and limitations, that the active managers should be able to beat that. The S&P SPIVA reports actually show that that's not the case, and it hasn't been the case for a very long time. And but thank you for making it clear in terms of what the dynamics underneath there are in terms of overweighting credit that produces those results. Very, very powerful analysis there. Now, notwithstanding that, we should just highlight with all asset classes, there are active management can also count. So I mean, you may have some active managers that are in that 15% over the long term that outperform, that 1.5 out of 10 managers, or some of those sub-asset classes within fixed income where active management does count. And certainly we will share the case. That is the case, we believe, in the hybrids market. In that case, you've got an asset class that is relatively inefficient, prone to undervaluations. It's an asset class that's very concentrated, and a relatively illiquid listed market too. So certainly at BetaShares, we're partnered with an active manager there, Coolabah Capital, to launch an actively managed hybrids fund. So it's a sub-asset class within fixed income. We believe that active management does count. And secondly, also we have partnered with Legg Mason, their affiliate Western Asset, headed up by Anthony Kirkham in Melbourne, who has a very long track record of actually outperforming those composite benchmarks. And we've got some analytics here to show the Legg Mason fund that we've partnered with, its performance versus the Ausbond Composite, and some other popular active managers that we have just titled Active Manager 1 and 2. So you can see over the very long term, there is some alpha there over the composite. And again, for the hybrids market, the BetaShares Active Australian Hybrids Fund against another popular active hybrids manager has outperformed too. So let's now move to just fixed income during the recent volatile times. Chamath, if you would like to make some comments, particularly around diversification there.
Yeah, so the volatility and the market stress that we saw in March really, highlighted the importance of fixed income as an equity diversifier. And it also highlighted the importance and the benefits of holding high-grade government bonds in your portfolio. So our government bond product, AGVT, had a tremendous first half of 2020, delivering returns of 5% and also delivered returns of 4.5% during Q1, a period where the equity market had a 20% drawdown.
Thanks, Chamath. That's very interesting indeed. Let's now move to this checklist, the sort of key questions, key criteria to ask of your fixed income manager or to assess your fixed income allocations presently. And we've really grouped these in 3 areas. The first one is the actual objectives and outcomes of the fixed income strategy. The second one is, well, what have the outcomes been? And thirdly, what are the future expectations? So really paraphrasing this, the questions here listed out in section 1 in terms of the objectives is really understanding what is the objectives here, and do these objectives meet your client's objectives or your portfolio objectives for fixed income? That is, as we mentioned earlier, diversification, income or capital stability. And do these match the outcomes of the fund that you've selected? Do they actually meet those needs? The second list of questions really are around really the performance, the how and why. Why has it underperformed? But also importantly asking the question, why, if it even has, outperformed too? Was it the credit? Was it how closely correlated has this fund been to equities? So they're the key questions to really attribute where the performance has come from. And the other key question we've listed there is to really understand and know what were the spreads during the recent Feb-March period. That really will be the proof point in terms of how the liquidity of the fund and a whole lot of other measures too. There's been some excellent analysis and summaries done by some finance journalists and research houses on exactly this point. And we're certainly happy to share that analysis on both ETFs and unlisted funds in a follow-up meeting with you. And then the third one is around future expectations. So actually tabling out what are the current characteristics of the fund and what to expect both in a lower rate environment and in terms of any change in inflation expectations. So we are going to list out these questions in a checklist or a worksheet and send that to you after this presentation. But Chamath, anything else here that you wanted to comment on these list of questions?
Yeah, I mean, ultimately, you need to ask, what am I getting for my management fees? And am I paying for equity beta in what should be a defensive building block?
Thank you. Let's now move to efficient solutions now. So Chamath, again, with ETFs, because ETFs are available to all investors, they're available to advisors, direct investors. In some way, we describe them as the democratization of investing. Particularly for fixed income, where sub-allocations, certain strategies were only the domain of large institutional investors, are now available to all investors. Could you please share with our advisor and institutional investors what have been really the 2 innovations from BetaShares in the ETF space here?
Yeah, so I mean, at a high level, our philosophy is all about giving power to the asset allocator and providing better building blocks to aid with portfolio construction. And those 2 innovations are really, one, disaggregating the bond market into the individual sources of return, whether it's duration and credit. And the second innovation is really better indexing, delivering those duration and credit building blocks in the most efficient way. And just for example, we cover all the major duration and credit building blocks within our suite. So if you want floating rate credit, you have Bank FRN's via coupon, or you can roam the capital structure via HBRD. Whereas if you want pure duration, you've got AGVT, you've got GGov. Or if you want something in between, a little bit of credit, a little bit of duration, you've got GBND, you've got credit. Or if you want a high quality active solution with a manager with a proven track record, there's BNDS. And just some ways of, you can think about how to implement fixed income to achieve better portfolio construction outcomes. An example is you've got a longer time horizon than more duration. But ultimately, all these come down to thinking about your portfolio holistically. So if you have more liquidity needs, maybe consider more government, more cash, and less credit. If you've got a larger equity allocation in your portfolio, consider more government, less credit. But even within equities, there's a bit of nuance in there. So if you've got more cyclicals, if you've got more value, if you've got more financials, then your portfolio might benefit from more government, more rate duration, and less credit. Conversely, if you've got more quality growth, such as if you've got the US tech mega caps, maybe you can benefit from more credit given these companies tend to be less leveraged. And finally, if you've got bond proxies, if you've got REITs, utilities, infrastructure, rate-sensitive equity exposures, but still carry a fair bit of leverage on their balance sheets, then maybe your fixed income exposure would benefit from less credit risk. These are just some examples of how you can implement duration and credit building blocks to achieve better overall portfolio outcomes. And what we've tried to do is have each building block serve a purpose. So we want our government bonds to be quite aggressive in their ability to diversify, for example. And we also want our credit building blocks to have enough credit spread duration, but they don't behave completely like cash. But if you want cash, we have the best product on the market in AAA. And the key thing to remember with fixed income is that it can generate outsized returns and improve portfolios in the right economic environment. And it still has strong portfolio diversification benefits, even with yields at historical lows, like we saw in Q1 with AGVT. However, things to be mindful of, and this is an issue that a lot of our more sophisticated investors are really trying to drill into. Be aware of your embedded duration in your equity portfolios, because the diversification benefits can vary depending on the type of equity exposure you're holding. And also be aware of the equity-like risk in your fixed income portfolios. Be cautious about taking excessive credit risk well into an economic expansion.
Fantastic, Chamath. Thank you for that. So just to summarize there on this part on the better building blocks, summarizing the two innovations really are, well, firstly is having the sub-exposures there. So disaggregating the fixed income market to its return premia of corporate credit, govie bonds, cash, floating rate note hybrids. And the second one that Chamath has highlighted is better index methodologies. So again, we're overcoming some of those limitations and issues of traditional bond indices, where the duration is bouncing around in terms of issuer weighting. So we're overcoming those too. And the other interesting one is that we're also embedding within our index methodologies typical processes that active managers use in terms of capturing roll yield. On this page here, we call this our fixed income term sheet. You can see all of the key statistics here across our fixed income suite. You can see the current rates, the yield to maturity, importantly what the roll return is, and then the expected total return. That expected total return is what we are physically distributing now. And in most cases, in fact, all cases on a monthly basis as a monthly distribution. You can see the term structures in terms of duration, what the fees are, And at the bottom there, we've got the credit ratings and the net assets. So we update this on a regular basis, and if any of you would like this sheet be sent to you, we're happy to do that also. Now, just by way of example, just to demonstrate this, is the better building block approach. If you were to precisely match the AusBond Composites duration and its sub-allocations, the split with the better building blocks would be AGVT, that's government bonds, CRED, which is corporate credit, so 55, 22, and 23 with floating rate notes, coupon. That would match the duration profile of the AusBond Composite. But with the better building block approach, the better index methodologies, whereas the composite is punching out a yield of, or total return of 136, the better building block approach is producing a result of 195. So that's 59 basis points higher. And in this low yield world, that equates to a 43% pickup in your return. Again, that's just an example there of that better building block approach, just versus the composite. We're very happy to do that analysis for you on some active managers also. So we might pause there. This was meant to be a short, sharp, and straight to the point fixed income webinar. Let's throw open to questions, and we actually received quite a lot of questions here. The first one is Anthony from Ballina in Victoria. The question is, so you are proposing that we go from one index holding of fixed income to 3. Well, the answer is yes, we are proposing that because it is going to give you a better return for your outcome. And I think importantly also is that if you are accessing ETFs and funds via your platform, having the additional 2 ETFs is not really an issue at all. It's just like selecting another 2 funds from the menu there. We've also, and if you're not doing it through a platform, you're doing it direct, then again, it's as simple as a share trade. I think also what it does provide from feedback we've got from advisors is that it also is a good discussion you can have with your clients too of why you actually have those subcomponents for fixed income. Chamath, anything else you wanted to add to that question from Anthony?
Again, it comes back to fixed income should not be one size fits all. It should be a tailored solution. And if that requires 3 different building blocks, then it requires 3 different building blocks.
Great, great. No, thank you. The other question here is around hybrids. So, yeah, what's just a question around just the benefits of a fund rather than direct hybrids. I did touch on that, and I think there are several here. And look, it's feedback we receive from advisors also, in that they're generally firstly, they're generally concentrated in 3 or 4 bank hybrids. Secondly, they've got to be across the term structure of the hybrids itself, which can be complex at times. Where an active manager, it's their role to be across that term structure. They are the professionals in that space. I think the other one also is the concentration on, or the illiquidity of the ASX too, where an active manager will have access to the OTC liquidity and much deeper pools. Chamath, anything else you wanted to add on that, on the benefits of?
So at the end of the day, HBRD, it's a capital structure roaming product, and it provides you access to a lot of levels in the capital structure that aren't available, say, on the ASX, such as OTC bonds, both senior and subordinated, as well as provides you access to OTC hybrids, which are increasingly becoming more common. The other advantage of this exposure does provide you access to the primary market, where fairly significant new issuance concessions can be found.
Interesting. We've got a question from Brisbane, sunny Brisbane. We've got Greg here who's asking about, given inflation expectations, what are the views of government bonds?
Okay, so obviously inflation presents headwinds to a duration exposure, but at the end of the day, if you're an asset allocator and you're trying to construct a balanced portfolio, you should have both inflation and deflation protection within your portfolio. And I would argue that you'll get much better inflation protection and much more upside from inflation expectations increasing through tilts within risk assets, such as tilting towards cyclicals and tilting towards commodities, rather than making tilts within fixed income, such as going into inflation-linked bonds or going into floating rate credit. You will get far more inflation protection on the risk asset side.
We might take a few more questions here. So a question is, well, what's next? What's next in terms of ETFs from BetaShares? I'm assuming that's for fixed income. Chamath, what might we be able to share there?
Yeah, so right now, global credit is an area that we are actively looking at right now, and stay tuned, because it is quite an exciting space.
We have a question here from New Zealand. We've got John here from north side of Auckland in Takapuna. You paint a pretty grim picture for active managers. So what is the outlook or future for active managers?
Look, it's a tough world for active managers because right now we're in a very low expected return environment, and management fees are a very large part of expected returns. So for active managers, they're increasingly incentivized to be allocating and taking on more credit risk and more liquidity risk in order to present some kind of compelling post-fee yield. But unfortunately, that's probably not what an equity-heavy portfolio or a balanced portfolio would need. So either active managers need to dramatically cut their management fees, or they need to reposition themselves as alternative credit managers rather than core fixed income managers.
Yep. Interesting. Look, we've got a lot of questions here. We promise that we will answer all of them, so we'll come back to you. But in the interest of time, I just wanted to also share next steps here. So that slide that I outlined, the checklist of questions, we will send that to you as a template, really, that you'll be able to download from the follow-up email. We request that if you are able to complete that, please send that to your BetaShares account manager or simply to info@BetaShares. If you also wanted to attach what your current fixed income portfolio allocations are, we will then come back to you, reply back to you. We will actually have a look at that. Our analytics desk will and come back to you with some risk return measures, optimize that, and to the objectives that you state. So we will offer you that service there. So please feel free to do that. We'll also have a copy of this webinar and the slides also sent through to you too. I just wanted to say in closing also that, look, we find ourselves in a very difficult time here. We at BetaShares here are here to help. We're committed to continually providing you with relevant information and reporting to support you and your clients. So please stay safe. We wish you the best wishes to you, your team, and your loved ones. Thank you very much.
Thank you.